Welcome back to my channel, everyone. Thanks for tuning in. And in this video, I'm going to go over some of the mistakes to avoid when you first start trading options. Now, these are really stupid mistakes, which is good because they're really easy to correct. But in my opinion, out of my own experience, these are the top 5 mistakes that I see beginner traders tend to make when they first start out trading options. And all you really have to do is make a couple of little tweaks and corrections to your trading, and you're one step closer to trading these options better. And in this video, I'm also going to go over the do's and the don'ts with some really good tips to use when picking out your contracts and trading these contracts as well. But before I begin, if you learned anything from this video, it will be greatly appreciated if you subscribe to my channel, if you drop a like on this video, and if you want to follow me on Instagram. I post daily trading recaps and really good trading content on there. I'll link my Instagram in the description below. So without further ado, let's get right into the first mistake to avoid, which is stop buying way out of the money option contracts. So the number one mistake is that I see a lot of beginner traders, they go into the option chain and they buy way out of the money contracts because way out of the money contracts are cheaper in price. Usually beginner traders have smaller accounts because obviously they're playing with money they could afford to lose in the learning stages. You have to lose when you're learning in order for you to win, basically. So they look at the option chain and they see contracts, 20 cents, 30 cents, and they think, oh, I'm going to play these because they're cheaper and these could skyrocket in value. Really fast, without taking up too much time, everything out of the money is going to be shaded in black. And what out of the money means is that they have zero intrinsic value. By the time of expiration, if these are not in the money, they're going to be worthless. They're going to be worth zero. Because they have obviously no intrinsic value. On the call side, the strike prices are going to be above the underlying's current price, which in this case is Boeing, and we're at 162. So on the call side, every strike price that is above 162 is going to be out of the money. And on the put side, it's just opposite. Every strike price that is below the current underlying price is going to be out of the money and going to be worthless by the time of expiration. We are day traders and we don't really hold overnight. I'm not swinging these for 2-3 days, a couple weeks. I'm in and out within a couple of minutes, a couple of hours. So really, expiration and holding these is not really a concern for us day traders. But let's just look at this example really fast. And we have Boeing coming out of a 1-hour demand zone. Now, out of demand, we're in a buy imbalance. I want to take Boeing long. Now, from a new trader, from a beginner trader's perspective, let's say we have a $350 account. We want a long Boeing. My rule of thumb, it's very simple, and this is very important, is I only play contracts that have a delta of 0.30 and above. That prevents me from going way out of the money because the further we go out of the money, the lower the delta is going to be, and lower deltas basically mean the less chance of these going in the money by the time of expiration. Now, this is also key, is that the contracts do not have to go in the money for us to start making profit on the contracts. Example, we could buy 20 of them out of the money. Just, hypothetical scenario right now. We could buy these at 10 cents down here where my cursor's at, and these might go up in value if the stock goes up in value. They do not have to go in the money for you to start making money. Problem is that we can be right on the direction of the stock. This thing can rip to the upside, but because we bought way out of the money, these might not go and increase in value as they would if we were to buy, let's say, 2 or 3 out of the money. Now, this is all going to make sense. If this is confusing at first, it's all going to make sense when I get into all my points. It's going to tie in together like a big puzzle piece, and it's all going to make sense. Just believe me. So very simple. My rule is 0.30 and above. And basically what the delta is, if all other factors remain 0, your gamma, your vega, all other Greeks are 0, the delta is going to tell you the percentage chance of them going in the money. And the delta is also going to tell you the increase in value of the option premiums for every dollar the underlying stock moves up in price. So for example, what's highlighted right here for $1.70, these have a delta of 0.36. What that means is that every dollar Boeing moves up, with all other factors remaining 0, Boeing, these 165 strike contracts are going to go up by 36 cents per contract. And for every contract, that is $36. So let's say in this case, we want a long Boeing and we have a target of 163.60. A beginner trader would look at this example and see, oh, I have a $350 account. What I'm going to do is I'm going to buy the contracts for 35 cents, which have a delta of 0.09, and I'm going to buy 10 of them. Right off the bat, that is the wrong thing to do. Number one, the deltas are 0.09, which is below my 0.30. And two, they're looking at contracts which are super cheap because they could afford it. It is much better for you to buy contracts that have a delta of 0.30 and for you to buy less of them versus buying more contracts that are cheaper. So in this case, what I would do here is I would look at these 0.36 contracts. They have decent volume and they have decent open interest, which is going to go into my next point. They have decent volume and decent open interest. So these are the contracts I would buy. And instead of buying 10 of them, I would buy 2 of them, which is going to equal my $350 account. It's going to cost me $340. And now every dollar the underlying stock moves up, I'm going to make 36 cents per contract. And these do not have to go above 165 for me to make money. So all in all, very simple. Look for deltas that are 0.30 and above. Do not buy way out of the money. There's no guarantee. There's no exact answer for what contracts you should buy. They're all going to make money if you focus on this and you do not buy way out of the money because you want to be cheap about the contracts you're looking to purchase. So the next mistake I see a lot of traders make is that they trade very illiquid options. You have to stop trading contracts that have no liquidity. And what I mean by illiquid options is contracts that have low volume and low open interest. Now, in this case, where my cursor's at, we have these contracts, the 187.5 strikes. They have a volume of 9. Volume, very simple. Volume just means how many contracts were traded so far today. And open interest basically means how many contracts are in open positions. Low volume and low open interest is basically going to tell us illiquid contracts, and there's 2 main concerns with this. The first concern is it's going to be very hard for us to get a fill at a price we're comfortable paying at. If there's not a lot of people trading these contracts, obviously you're not going to have someone to sell, you're not going to have someone to buy from. So it's going to be very hard to get a fill at a price you're comfortable paying. Because of that, you might have to market order in, or you might have to put a limit on the ask if you're looking to long these contracts and basically remove liquidity from the market. And if you do so, you're going to be losing on slippage. In this case, there's not really any illiquid contracts here that I would play with a delta of 0.30 and above. But just to illustrate this example, let's say we play in the money contracts, which I never advise doing. But just for this example, the contracts where my cursor's at has a volume of 2 and an open interest of 424. Right off the bat, that's relatively low volume and relatively low open interest. Now look at the spreads. It's 1590 on the bid by 1780 on the ask. If we were to long these contracts, it's safe to say we're going to get filled at the ask, or maybe a little less than the ask, a little better at price. So around the 1780 mark. If we wanted to sell right away, because of slippage and because of illiquid options, the spread, the difference between the bid and the ask, is going to be much wider. And if we wanted to sell right off the bat, we're going to be losing on this trade because the bid is much lower than what the ask is because of low liquidity, and there's not a lot of people trading these contracts. Therefore, if we were to sell, we're going to lose about $2 per contract, and that's about $200 for every contract that we do own. So in this, going back to this Boeing example, a delta of 0.30, and these contracts right where my cursor's at, has decent volume and has decent open interest, nothing out of the ordinary for a low number, and these are safe contracts to play. You could even play the one above it, at the money, or one out of the money. They have a delta of 0.49. So right off the bat, that's above 0.30. And look at the volume. Yeah, it's nothing crazy. You're not going to have a hard time getting filled. The spreads are tight and the open interest is pretty high. So, 1 or 2 out of the money, not going to be a big deal in this case. So that brought me into my third point, which is watch the spreads. And then the fourth point is watch the timing of your contracts. Now, you can be right on the underlying stock's direction, but if you're wrong on the time frame of the contracts you're playing, you could obviously lose on the trade. So like I mentioned before, option contracts have an expiration, and by the time these contracts expire, everything out of the money is going to be worthless. So what's going to happen is we're going to have time decay and we have a time issue. We can be right on the contracts, or we can be right on the underlying stock direction, but if we don't pick the right contracts and the right time frame, we could still lose on the trade because time decay slowly eats and decays our contract premium. I have a very simple rule of thumb for this, and you should focus on this. So Monday through Wednesday, if we were to look at the calendar, Monday through Wednesday, I play the current week expiration. Thursday and Friday, if I'm looking to day trade, I will play the following week expiration. So every Thursday and Friday, I play the next week's expiration. If I'm scalping throughout the week, Monday through Friday, if I'm scalping, if I'm going to trade for 30 seconds, a minute, 2 minutes, whatever the case may be, it's safe to play that current week's expiration. But if I'm looking to day trade, I'm looking to catch a trend and ride a trend for the day on a Thursday and Friday, we are very prone to losing if the stock trades sideways and the stock trades against us on a Thursday and Friday if we were to play the current week's expiration. So very important if you're looking to day trade and catch a trend on a Thursday and Friday, if you're not quick with your entry and exits, time decay will eat you up if the stock does move sideways. So it's safe to say you have to have a defensive mindset. It's safe to play the next week's expiration on a Thursday and Friday just to be defensive. Still going to make money. You're not going to get crazy percent returns as you would if you were to buy, like, let's say a lotto or something. But it's just safer to play the next week's expiration. And that is personally what I do. And the last point is always have an exit plan and always know your risk. Before you put the trade on, you have to have a plan where you're going to enter and where you're going to exit. And you have to know your risk. Options, obviously, the most you can lose if you're buying long calls and long puts, you're trading naked options on the long side. Obviously, the most you can lose is whatever the premium is, because the most it could go to is zero, obviously. And we don't hold close to expiration, so going to zero is really not a concern. But the most you can lose is your initial investment. You put $350 into the trade. The worst thing that could happen is you lose $350. But before you go into the trade, you have to know your plan. Let's say we long, let me fast forward this. Let's say we long Boeing in this demand zone, and we long it right where my cursor's at. Our risk is down here, and our reward is this first resistance, and then we're looking for targets to the upside, which is probably resistance from yesterday, or just any major supply zone above. So just know your risk and know exactly your plan, where you're going to exit, where you're going to enter, and where your stop loss is if you're wrong. Your stop loss should be based on an area of the chart. Your stop loss should never be based on a dollar amount, because with trading options, it's very hard to set a stop loss and know exactly where the premiums are going to be at based off of on a chart when you're wrong. I have a video on option stop losses, which is going to help out better with an exit plan, help you get a better clue of where the premiums are going to be based on the underlying stock. If you haven't seen that, it's on my channel called Option Stop Losses. So that's going to wrap this video up. If you enjoyed it, if you learned anything, drop a like, comment, subscribe to my channel, and also follow me on Instagram. Appreciate it.